a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi, everyone. Welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about buffer or defined outcome ETFs that have been very, very popular this year. And that is because markets have been in a turmoil due to tariff-related uncertainties. And these buffer ETFs, they protect against the downside when the market falls. And they also allow you to participate in the market upside up to a cap. And that is the reason, because they protect your downside. And this year itself, investors have poured about $7 billion into these ETFs, and assets in these ETFs are now approaching $70 billion. This is one of the fastest growing ETF categories. Innovator has been a pioneer in this space. They launched their first buffer ETF in 2018, and particularly in 2022, when stocks and bonds both had a terrible performance, and bonds failed to provide any diversification or hedging benefits to investors. Since then, this category has been very popular. Now, this year we saw that in the first quarter, when stocks fell, bonds did provide some protection. Bonds did perform well. But this month, in April, we have seen that Treasury yields have surged and bonds have also fallen along with stocks. So they are not providing any hedging benefits this month. And that is the main reason why these buffer ETFs have been very popular. They were also in the headlines recently due to some high-profile asset managers talking about these strategies, either criticizing them or talking in support of them. So we heard from AQR, Blackrock, and West. We'll talk about those three giants a little bit later. But first, it is important to understand how these strategies work, because these are not simple strategies. You need to understand how they work and whether they are suitable for your portfolios. They actually perform according to their stated goals. So once you understand, then these ETFs, you can decide whether you should buy these ETFs or not. So it is important for investors to look at the index, which index the ETF is tracking, your ETF is tracking, the cap, buffer, and the outcome period. So let me go to Zacks.com, and this is one of the most popular buffer ETFs by Innovator. And I'm using an Innovator ETF as an example because they were the pioneers and they are one of the leaders in this space. Now, using the link, you can go to Innovator website for this ETF, and you can learn more about these strategies. They have a lot of education material. So you will see that you can find these strategies for different kind of indexes. The most popular ones use the S&P 500 index as the reference asset, but you have buffer ETFs for the Qs, the Russell 2000, and many other strategies also. Buffer levels can be 9%, 10%, or different levels, or even 100%. So if you have a buffer level of 100%, you are fully protected against the downside. In case BlackRock has been expanding their buffer suite. So they also use three different kind of buffer levels. So moderate buffers provide protection against the first 5% over each calendar quarter. Deep buffers, 5 to 20% of the underlying ETF losses, and max buffer in case of iShares, they provide full downside protection. So please understand what your ETF is trying to do. And then you will also look at the cap. The cap level will be different for different ETFs. And outcome period is very important. And outcome period is important because the stated outcome, the stated cap and buffer will be applicable only if you buy on the first day and hold till the end of the outcome period. You can buy and sell in between. There is nothing stopping you, but your outcome is going to be different. And you can learn about the outcome if you buy in between by going to the provider's website. They will guide you and tell you what your outcome will be if you buy in between. Now, how do these ETFs work? They hold a basket of flex or flexible exchange options. And in simple words, the strategy works like this. They sell call options, and that selling call options that limits upside returns. And then they buy put options, which limits downside risk. So you sacrifice some of your upside in return of protecting your downside. So here's another explanation how these ETFs work. So let's take the example of an ETF where the underlying asset is at the S&P 500 index. It has a cap of 15% and a buffer of 10% and a 12-month outcome period. So the different scenarios for this ETF will work like this. If the S&P 500 index gains below 15%, 10, 11, 12%, you will get full return. And you will get that 10%, 11%, or 12%, or whatever it is. If the S&P 500 gains above 15%, your gains are capped at 15%. You don't get anything beyond that 15% cap. Now, if the S&P 500 loses up to 10%, you lose nothing because that is your buffer. If it loses above 10%, then all those losses above 10% you will have to bear. You can buy or sell whenever you want. And again, there are ETFs which provide 100% protection also. So if you're a very risk-averse investor, then obviously you should look at those kind of ETFs, 100% protection or max buffer ETFs. And one of the popular ones that you could look at is by iShares Max J, which will provide 100% protection, Max J. So you can look at this ETF. Now, what investors should remember when using these strategies that most of these ETFs will protect only from a certain level of losses. So that 10% or 15% or 5%, whatever that is, or 100% if you're using the max 100% buffer ETFs. Then you should also remember, as I stated earlier, that buffer is only for that specific outcome period. You can still suffer losses over shorter periods if you sell or buy in between. Upside is capped, that you will not get any dividends. And you should also remember that these ETFs, they have high expense ratios. They're usually around 70, 80 basis points. iShares buffer ETFs are slightly cheaper. Now, these are suitable for risk-averse investors, particularly those who are nearing retirement or in retirement. Because if you are a long-term focused investor, then you should just ignore the short-term noise and fluctuations in between. Because if you look at the longer term performance of stocks, for example, I have taken the oldest ETF, the Spider S&P 500 Trust ETF, SPY. So this made its debut in 1993. And since inception, it has returned on an average 10.23% annualized. These returns have been much higher over the past 5 years. Now, this year is maybe going to be very different, but otherwise, stocks had such a fabulous performance over the past 5 years, almost double-digit annual performance, and over the past 10 years, they returned more than 12%. But if you, as I mentioned, if you are a risk averse investor, either in retirement or nearing retirement, then these ETFs are suitable for you. Or also if you have some known income needs to pay the down payment for a house or to pay for a kid's education, then these ETFs are suitable for you because there are many products, many investors, risk averse investors, they use products like fixed index annuities or market linked CDs that protect against the downside, but they are much less transparent. They have high investment minimums, long lockup periods, unfavorable tax treatment, and also much higher fees. So these protection ETFs are much better products for such investors. They will help you sleep better at night and provide you the required peace of mind. Now let's take a look at what these fund managers were talking about. So AQR released a paper. They basically said that these ETFs, so I will provide the links, or you can also Google. I will provide the links in the article version of this video. But this is AQR's paper. Basically, AQR said that these have been an investment failure because majority of these strategies underperformed on a 5-year basis. And they said that investors have better options than these option strategies. For example, they can just buy the S&P 500 index and some investment in 3-month treasury bills, or they can look at other diversification strategies. So diversify better. Now you should remember that AQR focuses on alternative investments. So they will of course talk about alternative strategies, but alternative strategies are sophisticated strategies not suitable for most investors, most retail investors. They are also much more expensive too. Then BlackRock. So BlackRock has been expanding in this area. They have been expanding their product, defined outcome product suite. So they released a very bullish paper and they said that they expect US outcome ETF AUM to more than triple to 650 billion by 2030. Now, these outcome ETFs, they also include other strategies, not only buffer strategies. So they talked about why they are so bullish on these outcome strategies, and these include income. So using covered calls for income, targeted protection, which is the buffer, and other growth strategies. All these use options to generate the targeted outcomes. So you can read the BlackRock paper too. Then West, which has a suite of these defined outcome ETFs, many in partnership with First Trust, they released their rebuttal of AQR papers. And what they said, so you can also read West's rebuttal. So basically, what they said that AQR did not ask the right question. They said that these defined strategies, they delivered on their stated outcomes, and their stated outcome is not to outperform. They are not designed to beat equities in bull markets. As we know, as I showed you, the S&P 500 index's return of the past 5 years, it was a strong bull market. And these are not designed to beat equities in those kind of markets, but they are designed to provide predefined outcomes and greater certainties in volatile markets. And West also pointed out that AQR, they included many ETFs, the mismatched data set. They said that in their analysis, they included many ETFs which were not buffer ETFs, but other options-based ETFs which aim at providing high income to investors. So here my 2 cents. You can read all these papers, but basically you need to understand what your investing goals are, and you need to understand how these products work and whether they are suitable for you. These products, they do deliver whatever their stated goals. Thanks for watching. Make sure to check out zax.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.